The U.S. weaponization of the SWIFT interbank messaging system in 2014 and 2022 was initially presented as a surgical geopolitical maneuver. The move was heralded as the financial nuclear option. And what was intentionally concealed was the predictable, systemic consequence: SWIFT's functional destruction as a trusted, neutral global utility. This single action fundamentally altered the transactional calculus for over $7 trillion in daily cross-border payments. The immediate $300 billion freezing of Russia's reserves demonstrated that ownership of dollar-denominated assets is conditional, not absolute. The paradox is that the most powerful demonstration of the dollar's financial dominance simultaneously initiated the irreversible search for non-dollar, non-SWIFT alternatives. This is the financial historian, where money, power, and history collide. And nothing is ever as simple as it looks. Weaponizing the system accelerated its own obsolescence. To understand this, we need to start earlier. The dollar's supremacy was never solely dependent on U.S. economic output. It was dependent on the system built around it. The real foundation was laid in 1944 at Bretton Woods, and critically reinforced by the 1970s agreement with Saudi Arabia to price oil exclusively in dollars, the petrodollar system. But the functional enforcement mechanism, the transactional backbone, was created later with the Society for Worldwide Interbank Financial Telecommunication, SWIFT, established in 1973. While SWIFT is technically a Belgian cooperative, its operational dependency on U.S. and European banks and its reliance on the U.S. dollar as the primary settlement currency made it an extension of U.S. financial power. SWIFT's core value was its near-universal participation and perceived neutrality. It simply transmitted authenticated instructions for payment between banks. This low-friction, high-trust environment allowed for the exponential growth of global trade and finance. By 2010, SWIFT was handling roughly 15 million messages a day, facilitating trillions in payments. The numbers told a different story than simple trade flows. The system demanded dollar intermediary accounts for most cross-currency transactions. Even a trade between Brazil and South Korea might transit through a dollar account in New York, a process known as dollar correspondent banking. This was the real shift. It gave the U.S. Treasury, through regulatory oversight, visibility, and ultimate control over global financial flows. The first structural vulnerability was exposed in 2014 when the U.S. used the threat of sanctions to restrict Russian banks' access to U.S. correspondent accounts following the annexation of Crimea. This was a clear signal. The critical infrastructure of global finance was not a utility. It was a weapon. The reaction was immediate and structural. Russia accelerated the development of its own system for transfer of financial messages, SPFS, and China boosted the development of the cross-border interbank payment system, CIPS. These actions were not symbolic. They were the first signs of de-dollarization infrastructure investment. The financial world was now operating on the assumption that a critical piece of plumbing was unreliable. The critical blow came in 2022. The decision to remove several major Russian banks from the SWIFT network was an escalation beyond mere sanctioning of a few correspondent accounts. It was a technical execution of financial exclusion. This established a precedent. Any nation, regardless of the size of its economy or its historical trade relationships, could be cut off instantly. This directly violated the principle of financial universality that the dollar system was built upon. The confidence mechanism that sustains fiat money is not based on gold, but on guaranteed access to payment infrastructure. Confidence became currency. When that guarantee is revoked for political reasons, the logical institutional response is to seek alternative mechanisms that are politically neutral. This action triggered a geopolitical financial logic trap. For nations that prioritize sovereign stability over liquidity risk, Saudi Arabia, China, India, Brazil, the UAE, the trade-off suddenly shifted. The certainty of having your reserves seized, as Russia's 300 billion were, outweighed the temporary inconvenience of using a less liquid, parallel payment system. The dollar's primary advantage, its depth and guaranteed convertibility, was exposed as its greatest weakness, its political vulnerability. The historical foundation of the dollar's reign was predicated on U.S. adherence to the rules of global finance, even during political disagreements. The cutting of SWIFT demonstrated a clear, structural break from this norm. The modern mechanics of the dollar's decline are directly tied to the subsequent rise of alternative payment systems and the shift in reserve management logic. The immediate effect of the SWIFT exclusion was to accelerate the use of China's CIPS. While CIPS is smaller than SWIFT, its key advantage is that it primarily facilitates transactions in the Chinese yuan, RMB, and is thus largely outside the reach of U.S. primary sanctions jurisdiction. China's trade with Russia and other sanctioned nations has increasingly been settled in RMB, demonstrating a clear bypass mechanism. The trade settlement figures show the shift. The share of Russian exports settled in RMB rose from negligible levels in early 2022 to over 16% by 2023. The institutional incentive is clear: reduce dollar dependency to mitigate geopolitical risk. This shift creates a confidence loop problem for the dollar. As more bilateral trade agreements, especially oil and gas deals, transition from dollars to local currencies, or RMB, the global demand for dollars decreases. The illusion holds until it doesn't. Oil sales require dollars, creating perpetual artificial demand. When Saudi Arabia begins seriously considering selling oil in RMB to China, as reported discussions indicate, it removes a critical pillar of the petrodollar recycling mechanism. The flow of petrodollars back into U.S. treasuries is reduced, creating liquidity dependencies elsewhere in the U.S. financial system and challenging the stability of the bond market. The dollar's role is shifting from a guaranteed transactional currency to a potentially risky, politically encumbered asset. Furthermore, the swift action has dramatically altered reserve management logic among central banks. Historically, reserves were held primarily in U.S. treasuries due to their deep liquidity and assumed safety. Russia's $300 billion reserve freeze demonstrated that this safety assumption was fundamentally flawed. The rational central bank response is to shift away from politically exposed fiat assets to structurally non-sovereign assets. This directly explains the record level of central bank gold purchases. In 2022 and 2023, central banks bought over 1,000 tons of gold each year, signaling a clear shift from fiat reserve to physical reserve. This is a direct, quantifiable reaction to the weaponization of the dollar system. Markets enforce what politics avoids. The system is now experiencing a fundamental restructuring of power asymmetries. The U.S. derived immense power from its ability to issue the world's reserve currency and control its messaging infrastructure. That power is now being actively diluted by the creation of parallel structures, CEPs, India's UPI, and potentially a multilateral BRICS payment system. These systems operate on different protocols, often using blockchain or distributed ledger technology, DLT, to increase speed and reduce reliance on a central intermediary. The rise of central bank digital currencies, CBDCs, especially China's digital currency electronic payment, DCEP, is the ultimate systemic threat. A DCEP-based payment settled over CIPS entirely bypasses both the dollar and SWIFT. What cannot be repaid will be rolled over, but what can be instantly sanctioned must be replaced. The long-term consequence of cutting SWIFT is the institutionalizing of de-risking from the dollar. Every major non-allied economy is now treating the dollar as a potential operational liability rather than a guaranteed asset. The cost of maintaining the dollar's dominance, the provision of deep liquidity, and the promise of neutrality has been discarded for the immediate, short-term gain of sanctions enforcement. This trade-off is permanently damaging to the dollar's long-term utility. The financial world is not seeking a replacement for the dollar, but rather a diversification away from a single politically weaponized currency. Confidence decides who survives. The final stage of the dollar's systemic erosion is the internalization of the geopolitical risk by the market itself, leading to changes in yield structures and refinancing dynamics. The decision to weaponize SWIFT introduced a new non-economic variable into the pricing of U.S. sovereign debt: seizure risk. For large institutional investors and sovereign entities, the expected return on a U.S. Treasury bond must now be adjusted for the potential of political confiscation. This is not about credit risk. The U.S. will not default in the traditional sense. It is about access risk. This shift directly impacts the rollover risk of U.S. debt. The U.S. must issue trillions of dollars in new debt annually to cover budget deficits and roll over maturing obligations. If the largest foreign holders, specifically China and the OPEC nations, become structurally less reliable buyers due to the realized threat of sanctions and dollar weaponization, the U.S. Treasury must find domestic or smaller foreign buyers to absorb the supply. This requires higher yields. A small decrease in foreign demand can lead to significant increases in borrowing costs, increasing the U.S. national debt's carrying costs, which in turn necessitates more debt issuance. This is a destructive feedback loop for fiscal stability. The rise of the RMB as a direct payment alternative has created a clear institutional incentive for trade facilitation away from the dollar. Countries like India are now actively settling oil and defense contracts with Russia in non-dollar currencies, and increasingly, non-SWIFT channels. The cost of converting funds, which was once negligible, now includes a significant risk premium related to political uncertainty. The aggregate effect of hundreds of these bilateral agreements is a massive leakage of the dollar's transactional volume. This erosion is happening at the periphery first, in commodity and emerging market trade, but it inevitably spreads toward the core. The market signal is that the RMB is now a viable non-aligned transactional currency, a direct result of the U.S. abandoning neutrality. The emergence of tokenized commodities and DLT-based trade finance further accelerates the collapse of the SWIFT dollar hegemony. Utilizing blockchain for cross-border settlements eliminates the need for correspondent banks, SWIFT messages, and traditional settlement processes. This technological innovation directly undermines the need for a single reserve currency for intermediation. The transaction is no longer routed through a dollar account. It is settled instantly and directly using stablecoins or CBDCs that represent various currencies. This technology, combined with the geopolitical distrust created by the SWIFT action, constitutes an existential threat to the dollar's long-standing technological and political infrastructure. The financial ecosystem is now actively designing a world without the U.S. financial gatekeeper. The system is structurally replacing the dollar's utility with superior, neutral, and decentralized alternatives. This is the irreversible consequence of weaponizing a global utility. The financial world always finds a way around a toll collector who becomes too aggressive. The most profound realization is that the dollar is no longer an economic tool, but a purely geopolitical one, and the world is adjusting accordingly by finding financial solutions that eliminate the need to participate in U.S. geopolitics. The dollar will lose its uncontested status as the universal medium of international exchange. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.